All right, we're off to kind of a slow start on this Monday. Red on the boards. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, investors are bracing for a crucial week ahead. Fed Chair Jay Powell speaks later today, and that's ahead of Friday's all-important jobs report.
Automakers seeing a run of bad news. Stellantis joins Volkswagen and Aston Martin in issuing the latest profit warnings, partly blaming sluggish demand from China.
And this on M&A Monday, DirecTV and Dish agreed to combine in a deal that will create the biggest pay TV provider in the U.S. All that and more coming up, but let's take a look at where markets are trading 30 minutes until the bells ring. As Matt mentioned, not too great on this Monday. Of course, we're coming off of several consecutive weeks of solid gains, seeing some of the steam come out of the market right now, out of that rally right now. Even with that big run in Chinese equities, you're not seeing that good vibe music over there translate into the U.S. market. The S&P 500 currently down about 0.2%. The NASDAQ 100, your big tech names, which have been leading, currently down about 0.3%. And still a little bit of a sell-off in the bond market right now, Matt. You're not seeing that haven rush necessarily. 10-year yields currently up about 3 basis points.
All right, in terms of the runs that we've seen, Mohamed El-Erian, a Bloomberg opinion columnist and the president of Queens College, Cambridge, highlighted this chart here on Twitter, showing the S&P 500 has put up its best first 9 months of the year since 1997. The index is up more than 20% year to date, boosted by the 5th consecutive monthly gain in September. The S&P has gained for 10 of the last 11 months. So we've been doing pretty well so far this year.
Making me smarter this Monday morning, Matthew. Let's take a look under the hood as well here. Stellantis plunging after car makers said its forecast for the year would be lower as it plans to lower production. Just taking a beating now. You have Stellantis down more than 12.7%. You have Ford also down 3.2%, 3.3%. It announced that it will install free home chargers for EV buyers as competition heats up in the auto sector. We'll talk more about that later this hour. Also watching shares of EchoStar Corp up about 0.7%. Remember, DirecTV and Dish, which is owned by EchoStar, have agreed to combine in a deal that will create the biggest pay TV provider in the United States. Interesting, Matt, it has been up more than 15% since Bloomberg had reported that the deal would be happening.
Yeah, very interesting. We're going to continue to talk about those mergers. But right now, I want to talk about, or rather, takeovers. There's no such thing as a merger. Right now, I want to talk about what's going on in China. 6 consecutive days of gains there, and they had a bomb today, 9% up on the CSI 300.
Yeah, best run since 2008 or so. It's been pretty amazing to watch the CSI 300. It's now up over 20% year to date. It's in a bull market. You rewind to just a week ago, this index was down by more than 4%, or just about. So, I mean, the rate of change here has been just incredible. You're not really seeing it, though, in U.S. equities, and I think a lot of that we can blame on Germany.
I think you also have to ask if it's real or if it's a head fake, because 25%, more than that over a 5-day period. The reality is it's driven by stimulus. The underlying data is weak, as it is in Germany. I think the question is how much of that does that spill over, that weakness abroad, into the United States?
Yeah, Germany having obviously real problems, being the home of 3 automakers, all of whom have their own issues. But really, it's Chinese imports and inflation that are the biggest issue there. We're going to talk about Volkswagen. We're going to talk about BMW. We're going to talk about Daimler, as well as Stellantis, which is kind of like an Italian, Dutch, U.S. automaker, French as well, later on in the program. Right now, I want to focus on the U.S. markets with another chart Mohamed El-Erian highlighted on Twitter this weekend. It shows the strength of everything else, the everything else rally, with the equal-weighted S&P outperforming by the most since 2022. With us now is Morgan Stanley's chief U.S. equity strategist and CIO, Mike Wilson. Regarding the non-farm payrolls number due out this Friday, Wilson says we would need to see an upside surprise to drive a sustainable cyclical rotation in the U.S. And I understand that good news would be good news for some parts of the market, but wouldn't we want to see, in some ways, a miss, because then we could get a bigger cut from the Fed in November?
Well, yeah, maybe it comes with a fine line. I mean, the good news is good news until it's not, because then the Fed has to raise rates too much. That was the story before. Now it's bad news is good until it's too bad. So, look, I think there's three parts to what happened in the last 2 weeks. Okay, first of all, the Fed gave us 50. I think everybody was kind of expecting 25 right up until the last minute. And so it was still an upside surprise. Now, we had written about this. We thought 50 going into the meeting, if they could convey that it was not being done for growth concern reasons, would be a positive. So we got that, checked the box. And I don't think that was a shocker, but it was a positive event. And then we got the China stimulus. But that came in two pieces. Don't forget, right? It came with a monetary stimulus initially. And I would say most people, including us, were like, well, that's interesting, but that's not going to do much. We need fiscal stimulus. They're in deflation, right? We're not going to get any action in the real economy. So then, of course, the policymakers came in because they listened. And they said, okay, we'll do some fiscal too. And then we got this massive move. So we've had a 20% plus move in 3 days, which I would say very few people captured. All right. The other thing you have to think about, why is it up so much today? Well, Japan sold off sharply over the weekend. So I think China has been a source of funds for the Japan trade, for the India trade, all the other EM countries that have done well. Okay, and now you may see some reversion back, but that feels pretty overcooked to me at this moment. What we care about in the U.S. is the following. Is this going to change the trajectory of growth in the U.S. in a meaningful way? And the answer really is no. It can maybe get some excitement in things like materials, some of the industrial stocks who have direct leverage to perhaps a China stimulus of some kind. But beyond that, I think we need to see the labor market get better in the U.S., and we need to see the policy changes from the Fed have an impact on consumers.
Let's talk more about the labor market, because clearly a lot of investors are hinging on Friday's report. How much could that move the needle? And if you have a significant miss to the downside, what would that mean for equities?
I mean, for us, the labor market's everything now. And by the way, it's everything for the Fed.
Yeah.
So, this is the $64 trillion question. Did the Fed cut 50 because they are actually worried about the labor trends, which I think they should be paying attention to that? Or are they doing it because, look, inflation's come down and they're too tight to begin with, and so that they're able to, is the Fed cutting because they can or because they need to? So the labor market will tell us the answer to that. And, we've been pretty straightforward about this. If the unemployment rate goes up again, I think that's a clear negative. If the unemployment rate can come down and jobs data is okay without any major revisions, that would be a positive. That's
where I want to go. And you make that point in your recent research that we need no material downside revisions to the prior months. Unfortunately, for the bulls, we've seen that over and over again the past several months of NFP reports. I mean, when it comes to the quality of the data and these big revisions we still are getting, how much can you really trust it?
Well, even Chair Powell said that, right? He talked about the QCEW revisions being so dramatic. This is what you get in a slowdown. You get revisions to the downside. Just like when you have a recovery, all the revisions are to the upside. So this is not abnormal. And let's take a step back. This is what the Fed was going for when they raised rates. Once again, the big question is, can they arrest the downtrend, stabilize, and then see labor markets actually improve next year? We don't know the answer to that. We're going to get 2 labor reports before the next next Fed meeting. We're going to get an election, which I think is probably slowing hiring in the short term just because there's uncertainty around that. So yeah, it's going to be an interesting October, no question about it.
You also point out that you say earnings revision breadth is the best proxy for company guidance. And what exactly do you mean by earnings revision breadth? It's a little too much jargon for my mom. Hi, Mom.
Yeah.
And, what do you want to see and what is it telling you?
That's by design, Matt. We have these special terms, that only I know the answer. But no, earnings revision breadth is very clear. So it's the leading indicator for earnings revisions. So when I say earnings revisions, I mean, are earnings going up or down? And revision breadth we look at because that tends to be a leading indicator for whether it's going to be up or down. Revision breadth has been basically flat now for the S&P 500 for quite a while. And for the Russell 2000 and small caps, it's been negative. That explains a lot of why smaller, low-quality companies have underperformed, because the revision breadth and the earnings revisions subsequently have been poor. So now here's the thing for October. Typically, seasonally, revision breadth is negative going into third quarter earnings. Why? Because fourth quarter estimates are always too high. That's why stocks tend to not trade great in the first half of October. So we'll see if that pattern is changed. If we get positive revisions in the next 2 weeks, boy, that's going to be a real big positive, because that would be going against the seasonal trend. I expect them to be negative. The question is, will the market care? Because that's normal. We'll see. It's going to be, once again, a very idiosyncratic earnings season like it has been the last 2 or 3.
Well, that leads me to the question. We hit 42 record closing highs in the S&P 500 last week, Friday, and to today you have seen a cooling of that upward trajectory. Is there any more upside left in the S&P 500 for the rest of the year once election volatility cools up?
I mean, we wrote about this weekend, quite frankly. I mean, this is our bull case, which is that the amount of policy stimulus, okay, has been tremendous, particularly in the U.S., both fiscal and monetary. And that seems to be somewhat coordinated now, not only in the U.S., but also in China now, and other central banks are cutting rates. So that tends to allow multiples to expand further. You know, I would say 3 weeks ago, myself and most of the clients I speak with were in the camp that we would have a tough 4 or 5 weeks into the election, and then you'd get a strong rally into year end. But I'm starting to think maybe it might be more the opposite. We may stay bid into the election, and then I think we get some disappointment post-election on the idea that fiscal's kind of peaked, right, into the election, and also the Fed then isn't fully priced. And then it comes down to the numbers. Can we continue to deliver the numbers that justify the multiple expansion we've already had?
Well, we're going to talk more about politics and the election in the next block. I want to go back to what you were saying about earnings, though, and the earnings breadth revisions. There was a really interesting note out from Torsten Slok over at Apollo this morning saying that 42% of companies in the Russell 2000 have negative earnings. For the S&P 500, for contrast, those big caps, that number is just 6%. So even with these revisions that you're watching so closely and the idea that maybe the Fed could cut more aggressively from here, I mean, how careful do you have to be about where you're picking your spots?
Absolutely. We talked about this last time I was here. Like, we don't hate all small cap stocks, right? I mean, we hate the Russell because it's a low quality, we don't hate it. We think it's a low quality index, and therefore in this kind of environment, that's not the instrument you really want to be long. That doesn't mean there aren't some wonderful small cap stocks within that. And this has been a very high alpha generating environment for a lot of our clients are doing quite well generating alpha this year because there are some very good longs and there are some very good shorts. And I think that's the way we're continuing to approach it, whether we're talking about small, large cap indices or even within sectors. And there we've been very clear. We want to continue to stay up the quality curve. We're not willing to go down the quality curve. We don't think things are cheap enough. We don't think the Fed is far enough ahead of the curve yet to stimulate interest there. That could change if we see the labor data improve.
All right, Mike Wilson, we are just getting started. Sit tight for a couple minutes. Let's take a quick look at what markets are doing. Of course, 20 minutes to go until the bells ring. You can see on this final trading day of September, which was supposed to be not a great month, we are seeing a little bit of red on the screen. The S&P 500 currently down about 0.2%. Same thing, too, if you take a look at the NASDAQ 100 pre-market. But still, all in all, it's been a pretty good month for equities. The small cap index that we were just talking about, the Russell 2000, currently lower by about 0.5%. Much more with Morgan Stanley's Mike Wilson coming up next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Israel bombed the center of Beirut for the first time in almost a year, with hostilities against Hezbollah escalating after the Israeli military killed the group's chief late last week. Hamas, who is still at war with Israel and Gaza, said the strike killed the head of its Lebanese branch. At least 1,000 people in Lebanon have died since Israel began striking the country in the past couple of weeks. Francis Ford Coppola's $140 million new film, Megalopolis, debuted over the weekend and only brought in $4 million in ticket sales. The Godfather director spent decades on making the avant-garde picture, even selling part of his own vineyard to raise the funds. Ticket buyers gave the film a D+ grade in Cinema Score. It's rare for a big budget movie to get less than a B-. And Vice President Kamala Harris is cutting her West Coast campaign trip short to return to Washington, D.C. for an emergency response meeting to do with the Hurricane Helene. The massive storm has been ripping through the southeast and has been blamed for at least 84 deaths so far.
And for more on all things politics, including what is happening with Helene, we are joined now by Jack Fitzpatrick of Bloomberg Government in Washington. And perhaps you could speak a little bit to how the current president and the vice president are dealing with the hurricane, particularly as we know that Vice President Harris has spoke with North Carolina Governor Roy Cooper to talk about the rescue and recovery efforts in what is a key battleground state.
Yeah, this is tricky because everyone involved, especially in the presidential race, wants to make it clear they are focused on the response to all the damage from this hurricane. But at this point, logistically, you cannot visit the most heavily impacted area, obviously with the roads out around Asheville, North Carolina. So the Vice President Harris, has cut the end of her fundraising trip short on the West Coast and is coming back today in Washington to go to FEMA headquarters to get an update, at least making it clear that she is focused on this. President Biden will speak about it at 10:30 a.m., and former President Trump is visiting Valdosta, Georgia, so in the area of the path of the hurricane, but not in the area that's most heavily affected right now. So it is something that's getting a spotlight in the presidential campaign trail. Again, no one wants to come across as if they're ignoring this, given how severe the damage is. But for real negotiations, real action, it'll probably have to wait. There may be a conversation in December about more funding, but right now it's more a matter of speaking about it, putting a spotlight on it, and making it clear that this is getting everyone's focus.
All right, Jack, really appreciate your reporting, of course. We'll continue to follow this story closely. That is Jack Fitzpatrick of Bloomberg Government in Washington. Meanwhile, we're back now with Morgan Stanley Chief U.S. Equity Strategist and CIO Mike Wilson. And Mike, I want to talk to you about the potential impact of a strike along the ports. Of course, you have union workers along East Coast ports and Gulf port coasts threatening to strike starting tomorrow, October 1st. And it seems like there is a lot of daylight between the two sides, to put it mildly. So if we were to see a strike, if we were to see a prolonged strike, how much of an economic impact could that have?
I think it's the second part, what you said. It has to be prolonged. I mean, the good news is that inventory levels are still quite high, kind of across the retail channel. So in some ways, it may provide some relief, potentially, that inventories can come down. Maybe there's some extra pricing here as supplies get short. But if it persists beyond a month or so, then it becomes a real constraint, and the costs start to really build up, and then we have a margin pressure. And for the Fed, I mean, the Fed then has to, if let's say this thing doesn't get negotiated, or it does get negotiated in a way where wage increases are significant, does that factor into 25 or 50 next meeting? So there's a lot of implications here. These are messy situations. I'm not optimistic, unfortunately, that it gets resolved this week. Probably need some more action before the two sides come together. But as I said, I think it's the length of the strike that will then determine the magnitude of the impact.
You're not known for your optimism.
It's not true. Well, I'm generally a half-glass full guy, but in this case, I think this is a tough one.
Yeah, well, I was thinking, what impact could this actually have on the markets? An interesting story, you know, politically and economically. But then I remembered what happened when that Evergreen boat got stuck.
That was amazing.
Yeah, in the Suez Canal. And those supply chain reverberations lasted for more than a year.
Sure.
You know, I mean, Aston Martin right now, its profit warning is because of supply chain problems more than it is China. Do you expect this could be a real problem at that scale?
Well, sure. I mean, we had the port issues during the pandemic where you couldn't get workers to unload the cargo.
Yeah.
So it's just one more example of how fragile some of these supply chains have become pre-pandemic, right? We've gone to this just-in-time inventory system, globalization, and manufacturing goods halfway around the world and then shipping them from there. And so, you know, I think this is part of the bigger question. Like, how are companies thinking about managing inventories, managing production, reshoring, et cetera, going forward? This is just one more example of that. And labor costs has been something that's been a real tailwind for 30 years, and maybe we can't be that confident about that anymore.
Well, as you both point out, I mean, we've been through this before. We've seen this movie before, and the argument is out there that companies maybe are a little bit more flexible in their supply chains, that maybe they know a little bit more how to handle these sort of crises.
Well, here's a question on that note. If you're worried about wages going up, being potentially inflationary, if you're worried about inventory shrinking here to this extent that you have to raise prices, then wouldn't both things be inflationary? At the end of the day, do you still worry about the trajectory of inflation when nobody seems to be as worried about it anymore, except maybe if you're Michelle Bowman?
Yeah, I think the inflation situation short term, I feel fairly confident about. But I think if we don't have a further, like, let's say things reaccelerate here because China's stimulus, which is a surprise, we get perhaps, gas prices continue to come lower. That's helpful. And then the Fed gets really ahead of the curve and they start cutting rates again in a way where people feel optimistic. Well, then, yeah, I think then you're going to be back into the other camp. This gets back to our original thesis coming out of the pandemic, which is going to be we're in sort of these shorter, hotter cycles. We don't have all these tailwinds anymore, these relief valves that we've had for the last 30 years of falling inflation, falling interest rates, falling labor costs, outsourcing of production. And so these are all things that make the supply side of the equation harder to manage. And that creates this boom bust almost in the inflationary cycle. I'm not worried about inflation right now, but I think it's a great question for 2025.
And Mike, just quickly here before we let you go, let's talk a little bit more about the U.S. election. There was an interesting note out from Evercore saying that, well, a century of returns show that united government handily outperforms divided. This time could be different, that in this specific scenario, actually a divided government might be better for markets. And with that in mind and that history that we have here, how closely are you watching the down ballot races?
I think the congressional election is way more important for markets than the presidential election, okay? And the main reason is because of legislation. I would say that a unified congressional outcome is definitely bad for bond markets, okay? I'm not so sure about stock markets because you'll probably get more stimulus, which is going to be bad for the fiscal situation, but that may be okay for stocks, right? Because the stock market likes growth. The stock market likes inflation. I mean, it's a misunderstood concept, right? People think, oh, inflation is terrible for stocks. Actually, that's not true. When inflation was booming, that's when we had the best breadth in the stock market. That's when the Russell 2000 was doing really well because that's their pricing. That's their nominal GDP growth. That's their nominal revenue growth. So I think, to me, a unified government on the congressional side, you get more stimulus, probably better for stocks than bonds. If rates go up too much, obviously it's not great for stocks.
Mike, great having you, and thanks so much for joining us. Mike Wilson there from Morgan Stanley, U.S. Equities, Chief U.S. Equity Strategist and CIO. Coming up, Ford's new incentives for its EV customers. You're going to see more automakers coming out with price cuts and incentives. Details next in Social Climbers. This is Bloomberg.
Time now for Social Climbers. The company's making waves this morning. And first up, Ford offering free home chargers and installations to customers who buy its EVs in a bid to boost sales. The offer is a new approach to addressing what consumers say is a primary obstacle to purchasing an EV: range anxiety. Next up, Levi Strauss teaming up with Beyonce in a series of ads capitalizing on the buzz generated after the pop icon released a song on her album Cowboy Carter with the denim maker's name. The Levi CEO said that the shout out was, quote, completely organic. Now, coming up, less than 4 minutes until the opening bell, we'll discuss the market moves with Margie Patel from Allspring Global Investments. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We do see futures pointing lower on the S&P, about 0.2%, about 0.2% down on the NASDAQ as well. But it's still been a pretty sweet month for stocks. We're up almost 2%. It's the fifth consecutive month of gains for the S&P 500, and we're up 20% year to date. So nothing to sneeze at. Here at the New York Stock Exchange, you're going to see ResMed ringing the bell for their 35th anniversary. And down at the NASDAQ market site, our good friends at CNBC ringing the bell. Looks like their 25th year on the NASDAQ market site. Now, in terms of what's happening with stocks this morning, amid a slew of profit warnings from car makers that are in Europe and a bunch of records on stocks that are in China, let's go to Katie Greifeld to ask what's happening on indexes here in the United States of America.
Yeah,
Katie?
all of that is weighing on U.S. equities right now. On the final trading day of September, you can see we're nursing slight losses here on the S&P 500, currently down about 0.2%. Same thing, too, if you take a look at the NASDAQ 100. These aren't big big moves. And like you say, Matt, of course, we've had a pretty good month. And you can see that in the Russell 2000 as well. That follow through the small caps currently off about 0.4% on this September day. Some stocks to watch underneath the surface. Let's talk about shares of Chinese stocks extending their rally on speculation over the government's stimulus plans. The Chinese market has officially entered into bull market territory after a rip-roaring week, a week that really hasn't followed through in U.S. equities, Sonali.
I'm also watching Dish owner EchoStar. It agreed to merge with DirecTV, creating the largest pay TV provider in the United States. The two companies have gone back and forth over a deal for decades, but take a look, Matt. You have EchoStar shares down almost 5% as the market opens. This has been on a tear since we first announced that deal. We'll dig into it more later this hour.
All right, big share drops as well at the automakers, as I said. Stellantis, which owns Chrysler, Jeep, Ram, and Dodge, has lowered its outlook for the year. The automaker was already cutting costs and lowering production targets, citing more competition in the market, and here you see those shares off 12%. Let's take a closer look with Bloomberg Global Autos editor Craig Trudell. So, Craig, you know, it's not just Stellantis. You've had Mercedes out with another warning. We had Ford out with a colossal warning over the summer that just tanked the stock. What's going on in this industry?
Yeah, I mean, it's been kind of left and right in Europe. We've also had Aston Martin today with a pretty ugly profit warning. It's been a clean sweep in Germany with Volkswagen, Mercedes, and BMW just in the last few weeks. But I think what makes Stellantis really unique among these companies is, they have real operational issues in North America. And I suppose you could put Ford in that camp, but Ford was really more so an issue of quality and recalls. With Stellantis, it's an issue of having, been stubborn for quite a bit in terms of, keeping pricing elevated and allowing inventories to really get out of hand to the point where, a few weeks back, the dealers did something really unusual and published an open letter criticizing CEO Carlos Tavares. And so, this is in some ways a kind of response that speaks to just the issues that they flagged. They wanted the company to step up and help them clear inventory. That's part of what's happening here is they're slowing production, they're increasing incentive spending because they just have too many cars and trucks on dealer lots.
Yeah, it's amazing when it comes to Stellantis. Also projecting industrial free cash flow will now range from negative 5 billion euro to negative 10 billion euro. The previous guidance had been for positive cash generation. So quite a switcheroo there, Craig. Can we talk about GM a little bit, though? Because that chart we were just showing, all the shares of the automakers not looking too hot. And then you have GM just outperforming everyone. What has GM done this year that has really set it apart from the rest of the pack?
I think they have a fresher lineup to work with, and they have not been without, their mistakes operationally. I think, electric vehicle-wise, and, you look at some of the other more forward-looking bets, including on autonomous vehicles. I think Cruise has had real issues. That being said, the sort of, bread and butter for this company of big pickups and full-size SUVs, that product is both, fresh and strong and appealing to consumers. That is where they're able to price, most and really sort of pad their margins. So are they having some issues that some of the rest of the industry are facing? Absolutely. But Mary Barra does, seem to be sort of, rising above her peers in terms of, the way that they performed this year.
Yeah, I got to say, I was using Super Cruise this weekend on the highway, and it's just set it and forget it. And it's pretty amazing technology, at least in my limited experience. Craig, thanks so much for joining us. Craig Trudell there, a global auto czar, coming to us out of London. I want to get now back to markets with Margie Patel, Senior Portfolio Manager at Allspring Global Investments. And Margie, just on this, the auto industry, obviously, they have their own specific challenges, but they're still facing supply chain issues, as highlighted by Aston Martin. They're facing real challenges, most of the Western automakers in China, and they've got labor issues no matter where you look. How concerning is this, and how much is this an industry that really needs more Fed rate cuts?
No, I don't think Fed rate cuts would really make a material difference. Total cost of financing isn't all that big of a deal for a consumer to buy a car. But when you have an industry that has overcapacity, commoditization, excess regulation, labor rigidity, it's very difficult for companies to have competitive profit margins, and the weaker links tend to be accident prone, as you've listed all these companies that have had different blow-ups, all a little different, but all relating to a slow growth market, too much competition.
Is there anything about the auto market here, Margie, that you could kind of extrapolate into other sectors as well? This idea where, and maybe we've heard it in other places before, you need tremendous CapEx in order to have a payoff here with consumers, by the way, consumers that might be weakening. Where else do you see this story playing out?
No, I think the auto industry is really more unique. It's a general reflection of consumers being a little pinched, their income being decelerated. So I wouldn't, to me, it's a natural that you would see that there'd be problems with car demand across the board. But I don't think it translates to other parts of the economy. And here again, if you look at GM, they've had a tremendous performance year to date. They've distinguished themselves among the industry, but still it's been a very, very tough industry over the longer term.
Yeah, GM shares up about 30% year to date. Just breathtaking there. Let's broaden out, though, Margie, and let's reflect a little bit on the month that was, because September has contained multitudes. Of course, the first week of September was the S&P 500's worst week of the year. And then the following week, we were up 4%. Best week of 2024. So that kind of volatility that we're seeing on the trend higher, is there anything we can extrapolate out from that for the rest of 2024?
No, I think that was a lot of short-term trading, adjusting. Small caps had a big move. People reacting to the Fed cuts and some of the economic data that showed the labor particularly was a little slow. But I think that what we're likely to see is the economy continue to advance at a very modest level, 1.5% to 2%. We had a great 3% quarter. I actually just reported, but we think the economy will be slower, and so you really have to look at what sectors or what companies are going to have above average growth over the balance of the year. And it really isn't related to interest rates. It's really more what sectors are they in, where's the demand.
Margie, what stocks do you like here? I mean, we're up at 5,700 and change on the S&P, as I've been saying this morning, already up 20% year to date. We have seen kind of a broadening out. It's no longer just the Mag 7 stocks that are doing well, but are there a lot of stocks or a lot of industries out there you think still have a lot of room to run?
I would say moderate room to run. I don't think a lot of room to run. I think the technology sector is still going to be one of the leading sectors of performance balance of the year into next year. Often a more volatile sector, but it's the price you pay to get more return. I think the industrial sector has a lot of dynamics going for it that it hasn't had in previous cycles, long-term growth areas such as electrifying the grid, improving the grid, and incorporating technology, things like that. So I think there's a lot of opportunity there, more on that side rather than the consumer side, which looks as if, to me, will be a little bit muted.
And Margie, I'd love to get your perspective on what we've learned out of China over the past week. Of course, that drip feed of stimulus obviously having an impact on Chinese equities, not seeing it so much when it comes to U.S. equities. And I'm curious how you're thinking about this stimulus and what the best way to invest along it is. Is it just buying Chinese equities? Is it a commodity play? Do you potentially look at European luxury names? How are you thinking about it?
Well, we think U.S. is best, so we don't find China particularly interesting. And it's hard to see, except for the short-term reaction, that can change the long-term trajectory of the Chinese economy, which is for continued decelerating growth. You can't have a country that half of the economy is geared toward capital expenditures and exports, and 18% is geared to real estate, and expect that the economy is going to be vibrant. So we think it's not very interesting. We would rather see companies in the U.S. that don't have a lot of Chinese exposure because we think the growth is going to decelerate, and this is just a kind of a flash in the pan reaction in the market, not a change in their long-term growth characteristics.
Margie, we have to leave it there. Thank you so much for your time this Monday. That is
Thank you.
Allspring Senior Portfolio Manager Margie Patel. I want to bring you some breaking news as well. SoftBank's Vision Fund has agreed to invest $500 million into OpenAI's latest funding round, according to the information. And this would value, of course, the developer of ChatGPT at $150 billion before the investment. The deal represents the first investment by SoftBank into the Sam Altman-led company. And remember, it also comes as Thrive Capital is expected to be investing about $1 billion into this round. So SoftBank's investment is about half of that. Tiger, Coatue, Microsoft also participating in the round, according to the information. Now coming up, China stocks extend their rally as investors get FOMO. But can it last? We're going to talk about that next. This is Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, we have Seaport upgrading Disney to a buy, saying it's positive on the media giant's streaming business. The analysts note that some weakness in the company's theme park business still exists, but says that that's likely temporary. Next up, TD Cowen upgrading Accenture to a buy and raising its price target on the consulting firm. Analysts say that the company's path to recovery is more clear thanks to increased bookings in managed services care. And finally, we have Morgan Stanley saying that JP Morgan is no longer a buy, cutting its rating to the bank on the bank to equal weight following the Fed's interest rate cuts. And analysts also noting that rate reductions are more positive for the mid-cap lenders, Matt.
All right, let's turn to China right now. Chinese stocks extending, as we've been talking about, a remarkable turnaround, soaring for 6 days on the CSI 300. This script says a 9th straight day.
Wow.
I don't know what index that is. As government stimulus entices investors back to one of the most beaten down markets worldwide. Let's get a look at the Hang Seng China Dragon Index for the past week. Maybe that's the one that's been up 9 days in a row. Joining us at the desk is someone who knows everything about China and emerging markets. Damian Sassower is our chief emerging markets credit strategist for Bloomberg Intelligence. I was looking at the CSI.
Shenzhen.
6 straight days of gains exactly in Shenzhen, and 9% today. Yeah. Is this all from the stimulus that we didn't think was a bazooka?
So here's the way I look at it. A 16.3% rise last week alone in the CSI 300. I mean, Matt, that is basically the S&P year to date at 20%. I mean, they did it in a week. So that was by far the best week we've seen ever since inception of the index in 2005. Better than the week we saw back in November of 2008, which was a huge rally after GFC. So look, you know, Chinese equities are acting kind of like a very illiquid sort of asset class would, with light positioning, one that can get pushed around by some big bats. And I think that's what you're seeing here. Certainly the extension into commodities, which is really your mechanism, you know, your transmission mechanism for the currency side of the equation. You see iron ore up also, something on the order of what? 10% last week alone. I mean, it was in,
And, I mean, to that end, those are stunning moves.
Yeah.
Is it justified? If you look at the underlying economic data in China, this is stimulus that is propping it up. Can the stimulus last long enough to really outstrip the market here?
Well, I think you have to differentiate from monetary and fiscal stimulus, right? And everybody keeps saying it, but it's very, very true. All we're talking about are pledges, vows, promises from the PBOC and the officials in China that the fiscal stimulus is going to come, and this time is going to be different. But we haven't seen it yet, right? So, you know, unfortunately, I remain suspect. And look, for me, I mean, I'm an emerging market guy, so I have to look at the dollar. Yeah. And I have to look at dollar yuan, which is a huge cross that impacts most of the emerging market currency complex. And, you know, I look at, you know, on one side, you know, the risk of a hard landing in the U.S., and on the other side, a soft landing in the U.S. where inflation stays sticky. And that runway, that valley of the dollar smile is getting narrower and narrower as we head to the November election. So, you know, you've seen the dollar correct now pretty considerably. And, you know, for me, you know, it's very difficult, and I think the markets are kind of showing you this. It's very difficult to position one way or the other in the dollar. So most of the people that you probably have talked to, Margie at Allspring, they're talking about cross-currency trades. They don't want to touch the dollar, which is unusual given that the dollar is usually 90% of all FX transactions in the $7.5 trillion a day FX market, right? So, you know, so again, I take a step back and I have to look at dollar yuan here, and it looks a little bit stretched here as we push through the psychological 7 handle. And I look at euro dollar, and I think euro dollar is telling us a message that is not entirely true or believable, one that the U.S. growth, the U.S. exceptionalism we've recently witnessed is all but gone, and that Europe is going to basically play catch-up? I don't think so. I think that I'd be a little bit suspect on the euro here.
Okay, Damien, we have less than a minute, and I have two questions for you. Number one, which index should we be looking at? When it comes to Chinese equities, I mean, what is the most informative here?
It's not even an index for me. It's going to be BABA, JD.com, Baidu. It's going to be, it's going to be the big techs. Yeah, exactly. Kind of like the Mag 7 here. I mean, they represent such an overwhelmingly big part of emerging market equities writ large. And I think to that point, because you guys are equity guys, I'm a fixed income guy, but I will comment on the fact that you will see crowding out from the Korean and Taiwan semiconductor names because of this move in China, right? You're going to see some position reweighting. People are going to want to kind of chase this a bit. So, I think some of the other Asian equity markets could suffer off the back of that.
All right, we're up against the clock, so we'll just have to have you back for number two.
And
sure
I'll just quickly correct
Make sure not to wear such a
and say, you know what?
jacket.
The team in the control room was right. I'm looking at
9
now.
days.
It's
I think
9
so,
days in a
too.
row on the Shenzhen, the CSI
Hard
300.
to believe, but it's 9 days.
27%.
9 times.
Over 9 days. Anyways,
I don't
Damien.
recall him being sick 9 times.
Anyways, Damien Sassower from Bloomberg Intelligence, we thank you so much for all your time, all of your analysis. Now, coming up, we're going to talk about Merger Monday. DirecTV and Dish agreeing to combine in a deal that will create the biggest pay TV provider in the United States. That's next in our Wall Street Beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market about 22 minutes into this final trading day of September. You can see actually big tech managing to go green here. The NASDAQ 100 currently up about 0.1%. You take a look at the Russell 2000, also up about 0.1%. Can't say the same when it comes to the S&P 500, currently down about 0.1%, Sonali, but it's very early yet.
And it's time now for the Wall Street Beat, Katie, because today we're going to look at a mega media deal. DirecTV and Dish are agreeing to combine in a deal that will create the largest pay TV provider in the United States. TPG will acquire AT&T's remaining 70% stake in DirecTV for about $7.6 billion. Joining us now, Bloomberg's Crystal C. It's fascinating. Just look at those EchoStar shares today on the heels of this deal. We have reported that this was a deal that in some ways was kind of weeks reported, but also years, decades really in the making. What page does it really turn here?
Yeah, so that's right. This deal has been it's been considered in the past 2 decades. And if you think about how much that the habits of watching TV has changed, this is really showing in this particular transaction. When it was tried last time, they were not confident that this would get the regulatory green light, given you're combining 2 very big paid TV provider. But if you look about today, most people watch TV on Netflix, on Hulu. Like, you're going straight to the content provider, and you really are looking at 2 very big company that are hemorrhaging subscribers, and you're prolonging kind of the inevitable and seeing how people are going directly to the consumer, directly to the source of the content.
It's interesting. This deal apparently will give fresh funding for a 5G build out to EchoStar. But you look at EchoStar shares, the decline is just quickening today, now down almost 17%. Bloomberg Intelligence says EchoStar is sidestepping bankruptcy by selling off these pay TV units, Matt.
Right. I mean, it's funny when we talk about a mega deal because these companies are just fractions of what they used to be, right? They're going to have combined fewer than 20 million subscribers, and each of them had that in the past. So are there really going to be any antitrust concerns? I mean, does anyone really care about such a small part of the market?
They had that before, but now it really depends on who you consider to be a competitor. The subscribers number that you just mentioned, it's a fraction of what Amazon Prime has, what Netflix has, what HBO Max have. I think what they're really banking on here is what they call the skinny bundle, where you have a very concentrated bundle of genre, where you only want to watch sports, you only want to watch entertainment, reality TV. So you're kind of banking on that consumer will still pay a smaller price tag, but still remain a subscriber of these businesses.
Can we talk about the economics of this deal just quickly? Under the terms of the transaction, DirecTV will acquire Dish for a nominal consideration of $1, a single dollar, and will assume almost $10 billion of Dish debt. Is that a trade that I can make? Just pay $1 for $10 billion of debt?
You can try that if you have the stomach for it. And they've launched an exchange this morning, so kind of attracting the Dish shareholder to become a DirecTV shareholder. And this is actually a very complicated transaction. And TPG came in as well, kind of providing doing $2 billion worth of immediate financing just to bridge that current gap. And so really, this is the price tag that we're looking. It really is a price tag of the bond value more so than the amount paid in an equity check.
A lot of scuffle over that bond market value over the last couple of months, but also TPG only bought Angelo Gordon really a matter of the last couple of years, so buying that gave it the ability to do this. So private credit matters once again, Matt.
Yeah, no, for sure. We are all watching it very closely. Crystal, thanks so much for joining us. Crystal C there talking about the $1 deal, the $1 mega deal combining Dish and DirecTV. By the way, that's what Mortimer and Randolph Duke bet.
What?
Trading Places.
Oh.
You've seen?
Oh.
This is a reference that I'm not going to get, so let's move along.
Someone has. Coming up in the next hour, we're going to talk to the CEO of Mountain, discussing the timeline for his company's potential IPO. Then, National Tree Company's CEO talks about the looming port strike and the impact on the economy. National Tree makes Christmas trees and also Halloween trees.
Halloween trees. If we have time, I definitely want to ask how much of those he actually sells.
I want a purple one. This is Bloomberg. Hey, we're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, investors are bracing for a crucial week ahead. Fed Chair Powell speaks later today ahead of Friday's all-important jobs report.
And the clock is ticking. U.S. dock workers may strike at ports on the East and Gulf Coast. Bloomberg's Dani Berger joins us live outside a New Jersey shipping terminal with the very latest.
And to that point, a lengthy port shutdown could ripple across global supply chains as the holiday shopping season approaches. We'll speak with the CEO of the National Tree Company about the potential impact. All that and more coming up. But let's get a check on these markets. As Matt said, about 30 minutes into the trading day, not too pretty, but not too bad. The S&P 500 currently off about 0.2%. Of course, we've had a very good month for the U.S. equity market, taking a little bit of a breather today. Same story, too, if you take a look at big tech with the NASDAQ 100 down about 0.1%. And the bond market pretty quiet. Yields had been on the rise, but coming back a little bit right now. I'm going to go ahead and call that pretty much unchanged, Matt. The 10-year yield currently almost a basis point higher.
All right, let's talk about positioning now. Hedge funds bought materials stocks by the most since June of 2022 as China unveiled its massive stimulus. Bloomberg's Natalia Knijevich has more on this story. Natalia, what do you see?
Hi, Matt. Yes, it's really interesting because almost all subsectors within materials were net bought. Chemicals, metals and mining, even packaging and container ships, those subsectors were net bought. At the same time, we see that hedge funds sold infotech and energy. And overall, we can say that hedge funds are getting slightly more cautious. We see that they sold single stocks really aggressively last week. Overall, we can say that U.S. equities were marginally net sold last week. Of course, I have to mention Chinese stocks because Goldman's prime brokerage data shows that hedge funds bought Chinese stocks last week by the most on record. Now, let's get back to the U.S. stock market. Everyone is getting so bullish right now. Yes, we see some declines in the stock market today, but overall, if we look at put options and call options, there is not too much demand for bearish put options. However, those who trade the S&P 500 index are willing to pay much more for a downside protection. This is what this Bloomberg terminal chart shows us here where we are right now, and we see that it's still cost for protection. It's still much higher than it was before this August sell-off. So the biggest question, Katie, right now is this just positioning ahead of the U.S. presidential election, or it's a macro story?
All right, Natalia, great setup. Really appreciate your reporting. That, of course, is Natalia Knijevich. And let's broaden out this conversation now and take a look at how markets are positioned as we head into both Jobs Day at the end of this week and in 5 weeks the U.S. election. We'll do that with Scott Chronert. He is U.S. equity strategist and managing director over at Citi. And I'm going to go straight to one of the first lines of the email that you sent us this morning, that you view the S&P 500 as fairly valued, and as such, you expect more of the action to unfold under the surface. As you take a look at the 11 sectors of the S&P 500, where do you think the majority of that action will be?
Well, the way we're seeing it set up going into Q4, Katie, is as I said, sort of the S&P around 5,700 is through our 5,600 end of the year target. We'd consider this fairly valued. With rates coming down, it's a bit more supportive of valuations. But all told, what we see is limited upside at the core index level into the end of the year. So, but we do think this broadening thesis has been at work since the middle part of the year, continues to play out. And so the way we're focusing at this point is a barbell between traditional growth with some cyclicality. So our preferred sectors going into Q4 are going to be communication services, which captures the larger internet names, consumer discretionary, which we view as a trade on lower interest rates. We've also more recently upgraded energy as what I would refer to as a contrarian opportunity into the end of the year, and then we stick with an overweight on the financials, particularly via the banks.
I'm really glad you mentioned the consumer sector here, consumer discretionary. It was obviously a very loved trade over the last couple of weeks here, but you have that jobs report on Friday. If you see weaker than expected data, how do you play that, Scott? Do you actually dive deeper in because of the prospect of further cuts that could be steeper than expected, or do you stay away because you worry that the macro is weakening too much?
Yeah, that's exactly spot on the way this is setting up. So if you go back and look, the retail component of consumer discretionary felt its biggest drawdown in the first half of 22 when we were first going into that more hawkish Fed regime, right? So we completely understand that as you see the jobs data unfold, as you see economic conditions gradually unwind, that's going to have a fundamental negative impact that we have to be attentive to. However, we think the market will be more focused on what's to come in terms of further Fed rate cuts, which at the end of the day should support this component of the market.
You know, we always talk about inflation. It's still a bother to consumers, not because prices continue to rise, but because they're at such a high level. I wonder about companies, Scott, and the fact that we have no more inflation means they have no more pricing power, but they're still having to pay, you know, historically pretty high rates for labor. Is that a problem in your view?
Well, we think it's an issue, Matt, more than a problem that we have to navigate. So with our views this quarter, we've also taken industrials to an underweight. And I've been a longstanding bull on the industrial part of the U.S. stock market. But we think in the shorter term, this is exactly what you're getting at. The industrials, along with other more economic sensitive parts of the market, had benefited from rising inflation in the early stages of it. You were able to pass through pricing and we were supply constrained, and that was pretty good. So as you see fundamentals via the inflation metrics, you soften here a little bit. That's essentially how we see this setting up. We're going to want the more traditional beneficiaries of lower rates, let's call it consumer, who now is looking at some deceleration of inflation, potentially some deceleration of interest rates. But on the other side, your more economic sensitive and cyclically exposed sectors such as industrials, and we'd even throw materials in this category, are probably a little bit more at risk from a fundamental perspective in the intermediate term.
So I look at the autos, and this is where I'm thinking, you know, they've raised prices so much on their product that right now, in Stellantis' case, right, they can't get it off dealer lots, and they're having to pay so much for labor, in Volkswagen's case, that they're going to have to, you know, try and navigate German laws and close factories there. Are these stocks beaten down, in your opinion, enough that they could benefit from a rate cut because then financing costs are cheaper and consumers can actually buy the product?
Yeah, it's a good point. We're playing contrarian here. There's one big EV manufacturer that dominates the auto sector. We were overweight autos in Q3. We've taken that component down to an underweight. So even within consumer discretionary, we're sort of biased in how we're looking at this. So that auto's underweight, we want to consider versus a retail and let's call it consumer durables overweight. Consumer durables is where you're going to catch the home builders. So we're trying to be a bit more idiosyncratic in terms of how we see this rate influence lining up.
And let's talk about politics. We're less than 40 days away from the U.S. presidential election, 5 weeks. And you got a note a couple weeks ago basically saying that if you take a look at the platform of both Trump and Harris, that both are going to be negative for stocks, maybe the Democratic platform a little bit more so here. But how much does that hinge on a potential sweep by either party?
Yeah, so it all comes down to what your platform is and what's your chances of actually implementing that platform. And obviously, it's much easier in a sweep for either candidate. So we put that out there as a big proviso. Clearly, there are some measures that can get done via executive order. But generally speaking, this potential for a split Congress is going to muddy the waters in terms of how policy platforms play out. We would view a split Congress, generally speaking, as a more market neutral. But to your point, Katie, we're a bit more concerned that a Harris administration with a major focus on raising taxes is more directly negative for U.S. equities, whereas in a Trump platform, you've got a couple of competing issues here. You've got tariffs, which we view akin to supply chain disruption as an issue for fundamentals. On the flip side, you have a little bit more that you can push on deregulation. However, we've seen that story already. And so ultimately, you need a sweep, in our view, to see the more dramatic influences of policy platforms play through to fundamentals.
But to the extent that you have tax reforms here or further tax cuts really benefiting Trump marginally over Harris, in your view, as shown by your research here, in a split Congress, how likely is it with the fiscal deficit where we stand today to see an extension of corporate tax cuts at this rate?
Sonali, it's a great point. So I think this is the topic du jour. So you have the TCJA expiring at the end of 2025. Now, remember, corporate tax rates are set. It's really the personal tax rates that will expire at the end of next year. And the CBO, in its deficit projections and even its interest expense to tax receipt projections, is presuming that those personal tax cuts expire at the end of next year. What that does causes tax rates to go higher for the personal income measures. It also implies a potential benefit to the deficit math. As you begin to push out the current tax regime, what you gain in terms of that lesser tax burden, you're going to have to make up for in terms of how do you offset the pressure that potentially puts on the deficit. It's going to be a bit of an issue and a tricky one to navigate. I think that's going to be a topic for much of 2025.
Scott, we're looking forward to having you closer to the election, of course, to kind of read through all these changes. Of course, personal taxes has another impact that would have an impact on the market here in terms of consumption. That is Scott Chronert of Citigroup. Now, coming up next, Ryan Reynolds' ad platform is exploring going public with the help of Morgan Stanley. We're going to speak to Mark Douglas. He's the Mountain CEO next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Israel bombed the center of Beirut for the first time in almost a year, with hostilities against Hezbollah escalating after the Israeli military killed the group's chief last week. Hamas, who is still at war with Israel in Gaza, said the strike killed the head of its Lebanese branch. At least 1,000 people in Lebanon have died since Israel began striking the country over the past 2 weeks. Germany's government is set to abandon any hope at all of achieving growth this year, according to people familiar with the matter. Officials in Berlin are set to cut their forecast for growth in 2024 to stagnation at best, making it yet another lost year for the German economy. And DirecTV and Dish have agreed to combine, creating the biggest pay TV provider in the U.S. DirecTV will acquire Dish from its owner EchoStar for a nominal consideration of $1, plus the assumption of almost $10 billion of Dish debt. The deal requires Dish's bondholders to agree to taking a $1.5 billion haircut on the principal amount of the company's debt. Another IPO may be in the works. Connected advertising platform Mountain is said to have picked Morgan Stanley to work on an initial public offering. Bloomberg reports the firm could go public as soon as early next year. Joining us now here in New York is the CEO of Mountain, Mark Douglas. It is, of course, the ad platform for Ryan Reynolds as well. The two of you got together to do business here. Can you tell us anything?
I mean, it sounds exciting. I'm not sure. Like, we have a long-term relationship with Morgan Stanley, but honestly, we're focused on essentially democratizing TV advertising. So there's nothing I can really say. We're just going to keep focusing on building kind of the world's best and biggest ad platform for small businesses. So, but you know, it sounds like an exciting story. I can definitely say that.
I'm sure you read it with great interest there. So,
exactly.
We won't try to pin you on details there, but can you tell us a little bit about how your business is doing? I mean, what do your growth rates look like, and how's the rest of the year and potentially next year look?
Yeah, well, I think the overall ad business is doing very well right now. In particular, Mountain is entirely focused on streaming television. In particular, streaming's doing really well, and so you know, our goal has been to democratize the medium, to bring small and mid-sized advertisers into the television advertising market, and we're doing that. And it's a really exciting thing to do. We feel like we're transforming the medium. So the whole team at Mountain, we're really excited and very focused on that goal.
You know, I'm also really interested in kind of the changing landscape. The last time you were here, I think we were talking about Netflix and the opportunity for ads. As you sit here today, too, DirecTV and Dish are merging as well. Does that change the game at all? I mean, do two kind of weaker players, frankly, in the world of total television, do them being together create any leverage?
Personally, I don't think so. I think, you know, it's a real example of how quickly media and technology changed, because I remember a time when, you know, having like a DirecTV antenna on your roof was like that was the hot thing to do versus cable. And time just keeps moving forward. And I think now most consumers, not only they consume their media over the internet, they often consume it, you know, out the home, in the back of a taxi, you know, at a bar after work or wherever, and watch what they want when they want. So I think the idea of broadcast signals bouncing off a satellite, you know, this is the end of an era, and you know, they're squeezing as much as they can out of that end. But
you're focused on streaming. I saw a story on payments.com that shows Amazon has $1.8 billion of ad commitment for its streaming service this year. I immediately thought about politics, because we're supposed to be, you know, barraged by political ads with the $500 million Kamala Harris has raised, and I'm sure Trump has raised almost as much. I haven't seen any myself of these ads. Are they doing business with streamers? Are they still doing it the old-fashioned way? Are they spending money the right way or the wrong way? I think the wrong way. They're definitely doing it the old-fashioned way. So we live in this world where you can really precisely deliver the TV ad into the home. But when I talk to some of the big political agencies, and Mountain, we're not engaged in political ads at all, but we know a number of the largest political agencies, and they don't want to use the latest technology. They want to shovel money into, you know, basically broadcast television, local television, move as many dollars as quickly as possible. I think this is like peak, you know, TV ad spending right now. I don't think we're going to see it done this way in any future elections, and it'll be, in the future, it'll be done much more precisely. So I'm not sure the political parties are getting their money's worth right now.
Right. Well, before we look ahead to what, you know, that might look like in future elections, let's talk about this election, because it's been such a strange cycle, of course. We had Biden dropping out, and it's been a very abbreviated campaign for Kamala Harris. How did Biden dropping out, Harris coming in, sort of affect how dollars were being spent? Yeah, well, before Biden dropped out, you know, there were no dollars going to Biden. And I think Trump's campaign was getting a lot of the political spending. So to my knowledge, that's completely reversed. And, you know, Kamala Harris has to be defined, and one of the ways to do it is to broadcast out ads. And, you know, her party and her campaign are doing that. And I mean, I'm not sure it's being done as widely, to your point, that you haven't seen, you know, like a Kamala Harris ad, but it's definitely being done, I think, in key markets, has been done at a significant scale. I don't really watch broadcast TV. Right, yeah. But at some of the largest scale ever seen. I mean, I think estimated spend on this year's election, or this, you know, kind of president's election, is
$14 billion combined. I mean, it's just
races.
Right, yeah, it's just an insane amount of money to basically elect people to represent us in Washington.
The discrepancy is large. We reported at the end of September that Harris was outspending Trump by $5 million a day. She was outspending her campaign by 3 to 1.
Yeah.
But if the campaigns are being inefficient, how would you redirect them to spend their dollars? Would they be better off getting more notice on social media? Kind of like what Kamala Harris had at the beginning.
Signing up for TikTok.
Brat.
Yeah.
Right?
Yeah, well, they're getting a lot of earned memes. I mean, memes, the memes cost someone money to create them. But they don't cost the campaigns that much to get them out there. But I think, connected television streaming is the future of basically television advertising, and these campaigns could be doing much, much more on TikTok, on Instagram, on Twitter, and obviously on streaming television. And they're just not. They're just kind of stuck in the last election cycle in terms of execution. And whoever figures that out for the next election cycle, I think might have a big advantage.
I got to ask you, speaking of doing things in a new way, Paramount is apparently dropping Nielsen, according to Ad Age, to measure their viewership. And I wonder if that's kind of an antiquated system as well, the Nielsen rating system.
Yeah.
How do you measure, viewers for your clients?
Yeah, so on television with Nielsen, it's panel-based, meaning you basically ask people to tell you what they're watching on TV. There's so many more better ways to do it, and Nielsen's not doing any of those ways. So the better way to do it, one, on streaming, two, on virtually every television now, there's something called content recognition. The Shazam app where you're in a bar and you hear a song, you're like, I want to listen to that. Well, people do that for the shows you're watching on TV. So you can basically and it's built into most TVs to Shazam, not literally Shazam, but effectively use the same technique to know you're watching. So this idea of asking people what they're watching and collecting that, and a very small number of people, represent all viewing habits. I think Nielsen's another company that's kind of maybe stuck, we'll call it in the DirecTV era. And it's not going to, in my mind, it's not likely to make the cut for where we go next.
Right. Mark, got to leave it there. So enjoyed this conversation. It's great to see you at the desk. That, of course, is Mark Douglas. He is the CEO of Mountain, talking about political ad spending and maybe IPO plans. Still ahead, their ride has arrived. A SpaceX rescue mission has landed at the International Space Station to ferry home the 2 stranded Boeing astronauts. That's in our Social Climbers segment, up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, SpaceX's Crew Dragon capsule has arrived safely at the International Space Station this weekend. The ship, of course, will ferry the 2 Boeing astronauts back to Earth in February. And remember, that duo has been stuck in space since Boeing's Starliner malfunctioned on June 5th. Next up, Netflix suffered a surge in cancellations in the days after its co-founder and chairman endorsed Kamala Harris for president and donated millions of dollars to her campaign. Now, that spike in cancellations at Netflix, it lasted just a few days, and historically, the streaming giant has the lowest rate of cancellations in the industry. And finally, the med tech company Baxter International falling after news that its North Cove facility in North Carolina had to close because of the flooding in the wake of Hurricane Helene. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. A quick check on markets right now, about an hour into the U.S. trading day. And Matt, there is still red on the screen behind me. The S&P 500 down about 0.2%. Big tech now bearing the brunt of the selling, Matt, currently down about 0.5%.
Yeah, after it had turned around in the green, it's now down and getting worse. This is companies braced for major disruptions, not only from Hurricane Helene, but as port strikes loom. We'll speak to Chris Butler, National Tree Company CEO, next. This is Bloomberg. Ports across the east and Gulf coasts are bracing for a shutdown, not because of a hurricane, but because of a dock workers' strike. With no contract talks planned for today, the contract between the U.S. Maritime Alliance and the International Longshoremen's Association is set to expire. President Biden says he will not intervene in the dispute. Bloomberg's Dani Berger joins us now from a shipping port in Newark, New Jersey. Dani, let's talk first of all about what this strike is over. I imagine the dock workers want a substantial pay rise.
Yeah, substantial is right. They want a nearly 80% pay increase over the next 6 years. They say that the offer on deck, we don't know what it is at this moment because a lot of these conversations have been happening behind closed doors, but they say the offer at the moment is, quote, stingy. That's one big main point. The other big main sticking point is something we've seen in strikes elsewhere in this country. Think of the Hollywood strike. It's about technology. The port workers into the contract want a ban written in that they will not introduce new automation technology for things like loading some of these container ships like you see behind me. Now, it's the type of technology that already exists elsewhere. It's already in Asia. It's already in Amsterdam. And the employers here say that they need it to keep up with global competition. The port workers, they do have the upper hand. They have an administration that is friendly to them. There's not many people who want these jobs, so there's not a lot of people who can replace them. And that's part of the reason why the United States Marine Association wants to automate jobs.
Yeah, and I mean, listening to you speak, laying out both the technology piece and the wage rises under consideration, under discussion here, still a lot of daylight between these two sides. We heard from President Joe Biden saying that he won't intervene. Of course, we are 5 weeks away from the U.S. presidential election. What are the White House's options here when it comes to maybe helping to resolve this, short of direct intervention?
Well, one of the things that they've already been doing, again, short of direct intervention, is behind the scenes trying to mediate. They're going to be putting a lot of pressure on both sides, which is why a lot of experts here think that this will only last a few days. Now, they do have one option. It's the Taft-Hartley Act that essentially says, hey, we're going to put in place an 80-day cooling off period. And during that cooling off period, the port workers have to come back and they have to work. The head of the Longshoremen Association said that, sure, you can tell them to come back, but they're not going to be motivated to work. They will deliberately slow things down. The White House, of course, doesn't want to do that either because they want favor for the unions for this upcoming election. But it's a lose-lose situation. Either they upset the unions or they have an economic issue on their hands, which also makes for bad headlines heading into November.
Dani, we thank you so much for your reporting and looking forward to your coverage throughout the day. Of course, that is Bloomberg's Dani Berger reporting from Newark, New Jersey. Now, for more on the potential strike, we are joined by Chris Butler. He's the CEO of the National Tree Company. The company is a leading importer and seller of artificial Christmas trees, wreaths, and garlands. And you've told us that about 15% currently of your expected inventory is making its way to the New York port. And you could land all of those goods if there is no strike. But if there is a strike, it could really change things up. How do you see this strike, or the potential strike rather, impacting your operations through the end of the year?
Yeah, so it's a time game, right? If the strike doesn't happen, we'll be good to go. We'll get all of our goods in by the end of October, and we'll be able to sell all of those goods before the end of the year. For every day, what we're hearing, for every day of strike equals 3 to 4 days of delay. And so right now, if the strike lasts a week, we'll still get most of our goods in before the end of November, and we still should be in good shape. 50% of our sales happen after Thanksgiving Day, so when consumers really start to ramp up their buying of Christmas goods. So again, if the strike lasts longer than that, obviously then we're in a really tough situation, and we'll just have to see how that goes.
If you do fall short in terms of getting inventory for the Christmas season, does that mean that you'll have to raise prices? I mean, you'll have less supply and the demand will be the same.
Yeah, it really depends on competition, right? So if the competition is in the same situation as us, again, we'll never raise prices just because of any reason. If our costs go up, we always try and mitigate those with other things, but we tend not to just raise prices for the sake of it. But again, if next year, if this happens, this strike is prolonged, it will definitely impact shipping costs for next year, and that ultimately could lead to price increases for sure.
And we were having this discussion a little bit earlier that, I mean, the past couple years, really since 2020, have been defined by supply chain challenges. And I'm curious if the experience of the pandemic and, of course, what happened thereafter Has that made your supply chain more flexible? Are you more nimble now than you would have been in, say, 2019?
Yes, definitely. It's a great question. So we moved out of kind of 13 to 14 off-site warehouses, and we moved to our own warehouses on the East Coast and the West Coast. So, we like to have that bi-coastal kind of footprint, and so we're much more flexible. We were able to ship about 80 containers, shift 80 containers from the East Coast to the West Coast right at the last minute, and that's really going to help us in terms of our inventory positions.
It's interesting because in addition to your own planning, you have surveyed consumers about their purchase habits and their planning moving forward. They have said that budgeting and inflation, no surprise, there are a key factor here in how they purchase things into the holiday season. But if you see prices elsewhere start to rise, how much more of a crunch would you expect your consumers to be on? Is there kind of a ripple effect, a daisy chain, if you will, here on pricing across people who are expecting shipments this season?
Yeah, absolutely. So if general inflation starts to go back up again, which obviously it could, given the to your point earlier, the low demand, the low supply of goods, it will absolutely have a ripple effect to our business. I mean, we are a discretionary item. We like to think we're a necessity, but we are somewhat of a discretionary item. People switch their trees every 5 or so years, and so we think that if there's inflationary issues, they would kind of wait just one more year with the tree that they have. And so absolutely, if there's general inflation, I think 60% of consumers said that inflation and budgetary reasons would be the biggest determining factor to why they would buy one of our trees. The next being, seeing good promotions. After that, it would be the need for a tree. And then interestingly, the election had very little impact on whether people are going to buy a tree or not. So really, to your point, anything that drives inflation, anything that drives up costs, industries like us, which are, mainly discretionary items, will absolutely get hit.
I wonder, how many people have switched from a real tree to a product like the ones that you sell. I imagine, when they first came out, or in the 50s, a plastic tree was all the rage, and then people sort of shifted back. Now with climate concerns, are they headed more towards a man-made tree?
There's a lot of reasons why people have an artificial versus a natural tree. Look, we're fans of Christmas in general, but what I'll tell you is about 80% of consumers who celebrate Christmas with a tree have an artificial tree. And to your point, technology has come a long way. All of our, most of our trees that we sell today are pre-lit. They come in all shapes of sizes. National Tree has roughly 1,500 to 2,000 different types of trees. So there's really something for everybody, whether you want a small little tree for your apartment or for your kid's bedroom, to a large tree, that some of the trees that you showed in the pre-roll there. So, we have trees that cater to everybody's needs. Again, from an artificial perspective, you don't have to then clear up the pine needles, and you don't have to light it yourself. So there's a lot of benefits to that. In terms of one of the reasons that people like natural versus artificial is the scent, right? So they like the smell of that real tree in their home. We bought a company a couple of years ago called Sensicles, which is a scented stick. And that really gives the same scent. It kind of smells just like Christmas. It's a fantastic product. So now we can offer you the smell and the kind of the convenience of an artificial tree.
Well, Chris, it's not all about Christmas for you, is it? Because we took a look at your website before the show. You also sell Halloween trees. We're talking purple, we're talking orange, a variety of colors there. How much do those actually sell? How many people are buying artificial Halloween trees?
Yeah, a lot of people. So I'll tell you, Halloween is a heavy growth category. And the reason is because people like to change their decor every year. With Christmas, as I said before, roughly every 5 or so years is when people are switching out their trees to get a new tree. But with Halloween, with the wreaths, with the gowns, with the outdoors, with the trees, to your point, people love to switch that around every year. And so, the big retailers, the big manufacturers are really getting behind Halloween. So, we think this is a big growing area for us. Christmas is still #1 for us, but Halloween, we have a lot of fun, a lot of great Halloween items. And yeah, Halloween trees are really a growing trend right now.
Do you have any other trees in development right now? Are you thinking about a Passover tree, a Hanukkah tree, an Easter tree? How long can we keep this going?
As long as we possibly can. No, people definitely celebrate different seasons. So Valentine's Day wreaths, spring wreaths, Easter wreaths, to your point, Passover. Hanukkah. So, we're constantly developing, we're constantly analyzing market trends to make sure that we're ahead of that and to make sure that we're bringing our consumers what they're looking for to decorate their homes.
All right, a tree for every occasion. Chris, really enjoyed this conversation. Appreciate your perspective. That is Chris Butler. He is the CEO of the National Tree Company. Meanwhile, let's get a check on these markets. More than an hour into the U.S. trading day, you take a look at the S&P 500 right now. If we could pull that up, of course, it is the last trading day of September, and you can see we're pretty much unchanged, maybe a little bit lower. There's a clear direction of travel, though, if you take a look at big tech. The NASDAQ 100 currently off by about 0.2%, but mercifully all quiet in the bond market right now. 10-year yields, I'm going to go ahead and call that unchanged. Let's look under the hood, see if we can get more action going on there. Here is Bloomberg's Isabel Lee. And let's start, of course, with DirecTV and that merger with Dish.
Exactly, and we have AT&T shares kind of fluctuating. It's now trading flat. So AT&T and its joint venture partner TPG owns DirecTV, and we have EchoStar, which owns Dish. Shares are down 16%. So there are many things happening with this deal, and obviously it depends on many things, like the bondholders of Dish. But it's not that much of a surprise in a sense that both companies have been flirting on and off with merging. In 2002, we have the U.S. regulators actually blocking this deal, but landscape then is very different from the landscape now. Now it's a question of, do you have HBO or Amazon or Netflix? So the landscape really has changed, and we have DirecTV CEO saying it's a matter of when, not if. But for now, you see shares reacting. EchoStar is down by 16%, so that's really significant.
Stellantis was one of a wave of profit warnings from car makers. I have issues with this company, right? Because they have not done anything with their brands. They own Chrysler, and you can only buy, I think, one minivan. They don't have any other products.
Jeep, for example.
Jeep has done well, but they're priced so high, I think they were reaching a little bit. Dodge, they don't make my beloved Challenger anymore. You can only get a Durango and like a Dart. So, they haven't been making enough cars. They raised prices too much. They're not paying the workers enough.
Well, maybe that's why they slashed their profit margin this year, and it's down by 16%. They cite rising costs and an uber competitive market. I'm the type of person who refers to cars as it's a black car and it's a blue car, so I really can't relate so much. But we have analysts at Auto downgrading the stock to neutral. Piper Sandler also reduced its price target, and Bloomberg Intelligence said that the profit warning was bigger than feared. So your sentiments are being heard, Matt.
Yeah, the credibility that Auto has placed on Stellantis I thought was really interesting as well. Also have to check in on what we started the show with here. Stocks tied to China, of course, those big tech names there.
It's really all about the stimulus blitz. We have the CSI rising to its highest since 2008, Nasdaq Golden Dragon also up, and we have also individual stocks that are favorites edging higher. Alibaba up 4%, NIO up around 12%, and Bilibili, I'm not sure how to say that actually. Bilibili is up by 8%. But so it's a lot of good news, but we have some people who are skeptics. Lombard Odier, CIO, saying that he's dumped all the China assets from his holdings, and also he's not going to buy the rebound. So kind of harsh words there, but it's really two ways of looking at China. It's cheap enough for a reason, or it's cheap enough, let's buy it.
And it's worth noting that, of course, Chinese markets are approaching a week-long holiday, so maybe some FOMO buying going on. Bloomberg's Isabel Lee, thank you for that report. Meanwhile, we are awaiting President Biden due to make remarks on the administration's response to Hurricane Helene. We'll bring you those remarks as soon as he begins speaking. But coming up next, a story about reconciliation. Former U.S. Treasury Secretaries Timothy Geithner and Hank Paulson discuss the agency's role. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. And as the election nears, who will the next president choose to lead the Treasury? David Weston speaks with former U.S. Treasury Secretaries Timothy Geithner and Hank Paulson about what qualities are needed for the job.
Currencies are the kind of thing where everybody's got a view of what they should be, and the market's going to find its place. I mean, the way the dollar trades at any point in time is partly just a reflection of how people feel about the strengths of our institutions, the quality of innovation. We're still a safe haven, flight to safety in a messy, dangerous world, and that's a huge benefit. But people have to understand, people in policy have to understand that position the dollar enjoys, there's no entitlement to that. it's not like a guarantee. And you don't want to test people's confidence in that. And that requires running a country with responsible, sensible judgments about long-term fiscal challenges, about monetary policy and inflation, about how you use sanctions, about trade policy and protectionism. And so the dollar is a great strength of the United States, but it's not something that is a guarantee. You have to continue to earn it.
So you both have served as Treasury Secretary under a Republican and a Democratic administration. Without regard to what happens in November, the new secretary, whoever that is, what would you give them as their number one priority? What would you advise them, Hank?
Well, the number one priority is first and foremost, develop a relationship of trust with the president. Because Treasury Secretary sounds like it's a very important position, and it is, but the position, but all the power really comes to what's delegated by the president, and then the relationships they can build on both sides of the aisle, right? So what you have to do is you have to convince Democrats and Republicans, come up with ways to bring them together. Regulators are independent, but you can have a lot to say if you build relationships. So I think a lot of it, first and foremost, is building that relationship of trust, right, with the president, with both sides, Democrats and Republicans in Congress, and and with your colleagues,
and with markets,
yep,
and with people around the world that want to believe that they can trust in what you say, and you'll make choices with integrity. But I think Hank's absolutely right. The most important thing is that you have to recognize, you have to be in a position where you are able to say what you think is truth. And what is important for the country to do and not to do. And sometimes you have to be the brake and the constraint. And sometimes you have to be the accelerator, the catalyst to try to move a system that's hard to move to better choices.
I've always said you don't want someone as Treasury Secretary who's a politician who wants someday to be President of the United States, right? Because what you want to do, because there's a tendency to say what people want to hear, right? And you need to talk about what people need to hear. Yeah. But you need to have the support of your president to be able to speak that way.
And that, of course, was former U.S. Treasury Secretaries Timothy Geithner and Hank Paulson speaking to David Weston. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, we're awaiting President Biden due to make remarks on the administration's response to Hurricane Helene. We'll bring you his remarks as soon as he begins speaking. This is Bloomberg.
Let's get your trading diary to kick off this week. Later today, Fed Chair Jerome Powell gives an address at the National Association for Business Economics at that conference in Nashville. We'll get you more Fed speak throughout the week, including remarks from Bostic, Barkin, and Bowman. Of course, we bring you all those lines as soon as they cross. Tomorrow, we get Nike earnings, less than 2 weeks after the sneaker giant announced that it's replacing its CEO. Also, Tim Walz and J.D. Vance square off in the only scheduled debate between the VP contenders. I believe that's at 8 o'clock. We end the week with the September jobs report that may offer clues on the Fed's path ahead. Wait, is the VP debate tonight or tomorrow night?
Tomorrow in
night.
New York.
Tomorrow night, 8 o'clock. And we do simulcast that, by the way.
Yeah.
So you can watch it right here on Bloomberg Television. Listen to it on Bloomberg Radio.
It will be riveting, maybe more riveting than markets at this juncture, because you take a look at what the S&P 500 is doing, and it's not much. Currently unchanged, a little bit more action in the NASDAQ 100, your big tech names there. But of course, a quiet end to what has been a very volatile month. October begins tomorrow. September was supposed to not be too great. You think about seasonality, but the S&P 500 on track to finish September up by 1.5%. As Matt pointed out earlier, that would be the 5th straight month of gains, but at least for right now, pretty quiet. The S&P 500, again, unchanged, maybe 0.1% lower, Sonali.
I want to also bring you some news breaking a little earlier this hour. We are watching Merger Monday, and this through the eyes of the FTC. Chevron can move forward with its $53 billion deal with Hess Corp, with its acquisition, Matthew, after the FTC said that it could happen, this deal, on one condition, on a certain condition that CEO John Hess cannot join the board of the combined company. This complaint details the conversations, as they allege, between OPEC and the oil majors here, and this idea that the communications between John Hess and OPEC and competitors here about global oil output could really disqualify him here from serving on the board. So really complicated story between the conversations between OPEC and Chevron Hess as they move forward. One that the FTC brought forward because they were worried about the cost of oil moving forward.
Right. Of course, this is a hurdle to eventually clearing this deal. And as it moves forward, I mean, let's just talk about how big of a deal this is. Remember when this was announced, and we're talking about $53 billion for this tie-up between Chevron and Hess. This one condition, of course, I would imagine this signals that we're closer to the finish line than we have been.
Yeah, I don't think it seems complicated at all, frankly. I mean, they said, listen, John Hess, you've been communicating with members of OPEC in a way that we don't think is appropriate. As a result, we are not going to allow you to sit on the Chevron board. However, the deal can go through.
Yeah.
It's pretty cut and dry.
But the interesting thing about this to me, too, is not just the fact that this deal could happen now. Even with that said, both stocks are up, and the energy sector has been down for the month up till this point. Let's see if more M&A cleared by the U.S. government will allow more deals to come through.
All right, so watch this space as we look ahead to tomorrow. Coming up on Open Interest, we have Morgan Lucas. He is the Lucas Oil CEO. He joins us in the C-suite, speaking of oil. And of course, we still are awaiting President Biden, his remarks on Hurricane Helene. We'll bring you that when it happens.